Risk management is a very important concept, and in fact, there's a section of the syllabus, section E, that is solely devoted to risk management. And you can relate to why, because in that particular section, we'll be dealing with a lot of hedging methods using derivatives to manage risk. However, this video will focus on mostly the theoretical part of risk management, which is you understanding the risk management frameworks, how risk can be managed from identification to assessment to mitigation and monitoring. Right, so that's what I'm going to be talking about today. However, when we get to section E of the syllabus, we're going to calculation on hedging and all of that. So remember, why do we need to do risk management? Because as finance managers, we always plan. And what we have learned over time is that plan will not be always the same as actual. So our results will not exactly be the same as plan. And that is because of risk. So there is that possibility that it will not be the same. We know definitely it can be better, which means our actual can be better, or it can be worse. If it is better, then we are fine. We don't have problem. But where we have problem is when it is worse. When our plan is actually better than our actual, which is the same thing as when our actual is worse than our plan. We don't want that. So the objective of risk management is actually to minimize the bad surprise. So we want to minimize bad surprises as much as possible. Yeah. So before I go into the risk management details, few concepts that you need to understand, which I see students getting confused about. And the first one is exposure. You need to know what is exposure. And exposure is simply the basis of your risk. That is what is at stake. Yeah. What are your concerns? Yeah. What is the basis of you having such fear of actual, not the same as your plan? What are you afraid of? So that is your exposure. So we're talking about our concern. Yeah. The basis of risk. Why are we even talking about risk? Why are we bothered? Yeah. Usually it's about what can change. That will give us that kind of concern. That's exposure. There's also a concept called volatility. And volatility is how quickly or how often your exposure can change. Yeah. So it's about how quickly or how often exposure can change. So take for instance, if you take a loan, your exposure is interest rate. Because if you have a borrowing, you don't want interest rate to go up. So you have an exposure. Interest rate going up is a problem for you. The volatility is about how quickly that interest rate can change. So your volatility, remember, is about things changing so fast. Yeah, that's volatility. Very important. And also you need to understand what we mean by severity. And severity is just the value of a possible loss. What can you lose? What is the amount of loss you will suffer? Yeah, that is your severity. How bad can it be? Yeah, how bad can your loss be? That's your severity. Then we have probability. Yeah, probability is looking at the likelihood that the risk will crystallize. So this is about likelihood of risk crystallizing. Like that is becoming reality. Yeah. Or you call it occurrence, likelihood of occurrence. Yeah. So that's probability. Very important. So now, what is risk? I always tell you risk is just anything that can stop a company from achieving its objective. That is the meaning of risk. Whatever that can stop you from achieving your objective is the risk we're talking about. And quickly, I'll go through the types of risk that you need to be conversant with. The most important one, which we'll focus on in this paper, is majorly the financial risk. Yeah. Though there are other types of risks which I'm going to quickly touch on, but please take note, these are our focus for this paper. And when we get to hedging in section E, these are the types of risk we'll be focusing on hedging. And when you're talking of financial risk, there are three types of risks you are looking at. You are looking at the credit risk, you are looking at the liquidity risk, and you are looking at market risk. And quickly, credit risk is default risk, so which usually come as a result of the asset that you have. Take for instance, account receivable. When you have account receivable, you have a credit risk, and the risk is that your customers will default on their payment. So which means you might not be able to recover the value from your asset. So when you have an asset, you are exposed to credit risk. And liquidity risk is a risk that you might not have enough money to pay or to settle your obligation. So usually when you have a liability, you are exposed to liquidity risk, because with this one, you might be subject to solvency if you are not able to pay your obligation. So this is about you being able to match your asset to your liability such that you have enough cash to settle your obligations as they fall due. And the third one for financial risk is the market risk. And remember, market risk can even still be subdivided into price risk, the FX risk, and the interest rate risk. You touch this in FM, right? So the likelihood that change in price or change in FX rate or change in interest rate might lead to a loss of money is your market risk. So the possibility of having a financial loss. So in all of these three risks, you are afraid of having a financial loss because of changes that could happen in price, in FX, or interest rate, or the fact that you don't have enough liquid assets to pay your liability, or the people that are owing you are unable to pay what they are owing you, and you might lose some money there. So that's financial risk, which we'll be focused on. But there are other types of risk that you need to at least understand. And the next one I'm touching on is the operating risk. Yeah, and from the word operating risk, I'm sure you can relate with it. Yeah, usually this is associated with the nature of business. So because you're operating a particular area, yeah, almost like a business risk. Yeah, so the nature of your business. Yeah, you can also call it your business risk. Yeah, so my strategy might fail, or you might even lose staff. Maybe turnover is high, or people that are quite experienced in your business, they might leave you and might affect your business or your operations. You might not be able to operate properly. So these are the kind of risk that you will find in a company. Yeah. So very important to note this. Yeah. However, like I said, our focus is on financial risk. Yeah. So now let's go into risk management proper. Risk management. So anytime you hear risk management, please, 4 things must come to your mind. 4 things. The first one is the fact that you need to identify the risk. So first of all is identification. And this concept is so important because it is the same all over the sectors all over the curriculums, any paper you are doing, any exams you are writing, even if it's not ACCA, if it's CFA, if it's CPA, whatever. Risk management is risk management. So that's why it's good to just understand it now and understand it once and for all. So the first step is to identify the risk. Once you've identified the risk, you've listed them out, then the next thing is to do an assessment of the risk. And why is it important to do an assessment? Because if you don't do an assessment, you don't know how to mitigate the risk. Your assessment is trying to help you determine how important the risks are, because you've probably identified 20 risks. You should be able to prioritize them. Which ones are really major risk and which ones are not really something you should be bothering about. So your assessment will help you to ensure that your investment in mitigation is just enough and commensurate to the amount of risk that you are talking about. So you are not trying to get a gun to kill an insect. Okay? So, and what are you doing when you are doing assessment? What you are trying to do is you are checking the likelihood that the risk will actually crystallize, talking about the probability, and you're also checking if it crystallizes, what is the severity? Remember, we've touched on those concepts. So, how much impact? This is about impact. Severity is about impact. Yeah, how much impact? Yeah, that's what we're talking about here. How much suffering will you feel? Yeah, if the risk actually crystallizes. That is what the assessment is trying to determine. Because once you know that, then you can now mitigate. And that is the third stage, mitigation. And that is talking about what should be your response to the risk. And once you've mitigated, it does not end there, because risk is very dangerous, so you have to monitor it. Because a risk that is very minor and inconsequential now, in about 2 months, 1 day, 1 year, can change and become something quite important for you that can even run your company down. Right. So these are the 4 things that you must always think about anytime you hear anything about risk management. This is all risk management is all about. Yeah. But quickly, in terms of mitigation and your responses, it's good to know what are your options of responses that you need to adopt for the assessment that you have done. And I will draw a matrix for you that should help you. And like I said, it's the same in all curriculum. Whatever you find risk management is the same. Right. So I'm going to put severity on y-axis, and let's put likelihood of occurrence on x-axis. So I'm going to divide this into 4 quadrants. So which means likelihood is low here, and likelihood is high here. So high likelihood, high severity here as well, and here we have low severity. So this particular quadrant, when the severity is low, which means even if it crystallizes, there's no impact. So, and the possibility of it even crystallizing is very low. In this case, you don't have to stress yourself, so don't do anything. So here is no action. And your response is nothing. You are doing nothing. So in that case, you are saying you are accepting the risk. No problem. You are happy with it. Yeah. You are accepting the risk. However, if the likelihood is low, but if it happens, the severity is super high. Talking about this area. So in that case, you have to have a contingency plan. So this one, you have to do something. You have to do a contingency plan, or you say, okay, you are transferring the risk. That is why you do insurance. That is a popular example of how you can transfer risk by having insurance. You know, the likelihood of having an accident or fire burning a building is very rare because of the controls you have in place and everything. However, if it happens, the whole building might be burnt down. You might lose your whole car. So because of that, you have an insurance. Here is a possibility of having a high likelihood, so which means it will always or mostly going to happen if you don't do anything. Though the severity is very minimal, is low, but literally because it happens frequently, even with little severity, if it happens so many times and you accumulate little severity, it might become high severity. So too many occurrence, 1 plus 1 in 1 million places is already 1 million. So in this case, you cannot also keep quiet. So you have to do something. Yeah. And that is why you adopt a reduction approach. So here you have to reduce the likelihood of occurrence. So, and what you can do is to put controls in place to do that. The most critical portion, which is quite dangerous, is when the likelihood is very high and severity is very high. This one is an emergency. So you need to act immediately. And what you have to do is to leave that business. You can't do it. So you have to avoid. You have to stay away. Yeah. You have to stay away from that because the danger is high and the likelihood of occurrence is also very high. Yeah. So there's another model that you call 4Ts that you can also use for risk management, which is similar to transfer, avoid, accept, reduce. So like for accept, you say you want to tolerate. That's another word. If you're using 4Ts, so same thing, tolerate. You can say tolerate. And this is already transfer, yeah. So it's T already, so you can transfer. And you can as well terminate if you don't want it. If it is high likelihood, high severity, then definitely you have to terminate that risk. Stay away from it. Don't get close. Terminate. And for the high likelihood and low severity, you will say you have to treat it so that you will reduce the likelihood. Treat it. Yeah. This one you transfer. Yeah. Okay. So that is the concept about you responding to your risk. Yeah. And monitoring is the last part, which is very important. After your response, you don't stay there. Like I said, a risk that used to be in this quadrant can jump all the way to this quadrant after some year. Anything can happen, even from a risk can jump to this part. So you need to be careful. And the one that was there can also jump back, which means you need to save money and don't bother yourself. So they can move across this quadrant, and as they are moving, you are changing your strategy, you are changing your response. Very important. And that's the essence of monitoring. Yeah. But in the financial space, you can use financial ratios for monitoring your risk. Yeah. Yeah. The hedging method, we will deal with it in section E. But here you need to learn how to use financial ratios to monitor your risk. Yeah. Because if your profitability is coming down or your debt profile is going high or you are getting into liquidity problem, how do you know? And that's why you can use ratios to quickly deal with that. So remember, in the financial world, which is where we are, and that is what we'll be focusing on, I will talk about key ratios. Yeah. The first one is profitability ratio. You can also revise your ratios, very important. And the major one that you will use to monitor your profitability or the use of your asset is ROCE. Because this is the ratio that check how efficient you are actually utilizing the funds that have been made available by the fund providers. Talking about debt providers and equity providers. Right? So you know that if this ratio is bad, then you should be checking yourself to know what is really going on. Because to calculate ROCE, you remember it's profit before interest and tax. Then you divide it by the capital employed. And capital employed is your equity and debt. Right. Very important. And what are you saying here? You're saying that you want to know how the asset has been utilized. And this is divided into two parts. Looking at how the asset has generated revenue, and that is talking about asset turnover, calculated as revenue divided by asset. And that revenue that you have generated is not the profit itself. The profit is the margin on the revenue. So margin is very important, and that is you talking about the profit upon the revenue that the asset has provided. And that is why your profitability ratio of ROCE is also calculated by multiplying your asset turnover by the margin, the operating margin. This operating margin that we are talking about here, right? So you see that this is asset turnover, and this is operating margin. If you multiply those together, talking about revenue over asset, multiply by PBIT over revenue. So now if you cancel this one out, what you have back is your PBIT over asset. And remember, in your accounting equation, your asset is equals to liability plus equity. So that is why this is still the same thing as your PBIT over capital employed of asset, which is the same thing as liability plus equity. So that is an analysis that you have to really be comfortable with. So that is how to monitor your profitability, but you also need to be able to monitor your liquidity risk. So I'm focusing on financial risk monitoring now. So to monitor your liquidity risk, you already know the ratios. You're going to use two ratios, current ratios, and you're going to use your quick ratios. Remember, these are very simple ratios. Current ratios is your current asset divided by current liability. Ideally, you expect it to be 2, and at least around that 2. Or if it's anything super or significantly less than 2, you know there's a problem. And quick ratio, you need to adjust for inventory from your current asset, but still going to divide it by current liability. And naturally, ideally, you expect it to be 1. And if it's significantly less than 1, you need to be worried and need to act fast and do something to your liquidity, because you might be running into big trouble. Likewise, gearing is another way to monitor your financial risk. Yeah, and remember, gearing is debt equity ratio. That is debt divided by equity. And if you're talking of total debt, total gearing, you're talking of debt divided by debt plus equity. Both formulas are acceptable. Yeah. Usually you want something around 50%, but what you should also know is that it depends on a lot of things. Remember, gearing is about you're talking about risk, yeah, as a result of how a company is funded. How a company is funded. Please take this very importantly. Yeah. Is it a lot of equity? Is it a lot of debt? Yeah, you won about 50%, but the level of debt depends on so many things. So you can't say for every company it has to be in a certain percentage, because you're talking of industry is important. Yeah. If you're looking at manufacturing industry, there's a likelihood that they may have quite a huge number of debt to acquire big machines, to buy a lot of things. But if you're just in the service industry, you might not have so much amount of debt. Also, the size of the company is very important. Big companies tend to have high level of debt because they are even able to get more debt. Yeah, and probably expanding and all of that. So size of company very important. And also the prevailing economy is quite important. Yeah, if there is recession, you probably won't see a lot of debt because people will not be able to afford debt. Likewise, the bank might not even be willing to give anybody debt because nobody is trusting anybody during recession. You want to keep what you have at this point because people might struggle to pay back. So all of this will determine the level of debt and as such the gearing that will be appropriate for any particular company. So that's it about risk management. Remember, it's about four things: risk identification, risk assessment, mitigation of the risk, and finally monitoring the risk.